is the closing bell on Wall Street, and now it is market domination overtime. Jared Blickery going to be along to get us up to speed on the action from today's session. I'll start with the major averages here. The Dow finishing lower by about 100 points, call it 108 right now, about a third of 1%. But you saw kind of the unusual activity throughout the day. We got the news that President Trump had spoken to President Xi of China, and he described it as a constructive conversation. So we'll see where that goes from here. But the market's not that encouraged by that. We also had jobless claims this morning that came in a little worse than estimated. And we've got the BLS, the jobs report coming from the Labor Department tomorrow morning. The S&P 500 finishing down by about a half of 1%, really fading throughout the day here, but that similar sort of what I called a bouncing ball earlier kind of vibe. Nasdaq Composite down about 0.8% and seeing similar action. Jared, I don't know if bouncing ball is like a technical charting term.
In the industry.
That's what it looked like to me today.
Yeah, call it a sine wave, call it whatever. I was following this mudslinging by Trump and Elon Musk here. We'll get to Tesla in a second, but first, the indices closed down a little bit. S&P 500 volatility has really shrunk over the last week. So only with a 0.5% loss, this is the worst day in about a week, maybe a little bit longer. Nothing to write home about. I'll take a look at the VIX here real quickly. That's still under the 20 level, so nothing too bad there. And we had yields ticking down initially today, and it looks like kind of a mixed picture with respect to the 10-year and the 30-year. So the 10-year down 3 basis points, 30-year just about break even. Let's get to the sector action, and then here we go. Communication services, rather, that was the only sector in the green, up about 0.2%. Consumer discretionary, guess who's in there? Tesla, that was down 2.5%. Then consumer staples, the other consumer sector, that was down nearly 1%. I'll also mention materials, down 0.5%, also underperforming the S&P 500. Now let's get to the show in the Nasdaq 100. I will punch up Tesla here, down 14.26%. I believe this is going to be the worst market cap loss ever for Tesla. You'd have to go back to September of 2021 to see a second worst state, and this is going to be over 140 billion by my calculations. We'll have to see how things finally net out at in just a few minutes here. But Tesla, let's get the year to date so we can put this in context. Had a nice rally going and just gave a lot of it back in the afternoon with the back and forth between Trump and Elon Musk. And we're seeing a little bit more red than green on the screen, especially with respect to the mega caps. NVIDIA down 1.3%, Apple down 1%, and some of the other standouts in the upper right. We got Palantir down 8% and Costco down 4%. So lots going on in the Nasdaq 100. A little bit less or fewer fireworks in the Dow. And here we see some standouts. Goldman Sachs up more than 1%. So is Salesforce, kind of in the middle of your screen. But more red than green for the Dow as well. So a little bit of a setback today in the majors and some of their components. Back to you, Josh.
Thank you, Jared. Well, U.S. stocks wipe out gains on Thursday amid the escalating tensions between President Trump and Tesla CEO Elon Musk. Investors also keep an eye on trade talk developments between Trump and China's Xi Jinping. For more on the market action, we're bringing back in here FedWatch Advisors founder and CIO. That would be Ben Emons. Ben, great to see you again on set.
Good to be here.
So let me ask you, and I want to touch on what Jared just did there, which was obviously this public brawl that has broken out, Ben, between President Trump and Musk. It has gone public and personal. It's gotten very heated. The issue, Ben, or at least one issue, would be the big, beautiful bill, right? Trump's budget bill. Musk doesn't think it's so big and beautiful. He wants to kill it. I want to get your take on how you think market participants should be thinking about that budget bill. Because you wrote in your Substack something interesting here, Ben. You said that the debt load we're dealing with here, you called it, for investors, the lurking, abominable snowman. What did you mean by that?
Yeah, so one, I was inspired by the abominable, like it's in, because that's what Musk was talking about. But this idea that it is a creature, right? It's like the debt is a kind of a lurking creature and has an issue with being sustainable. You know, we're not growing fast enough to pay off our debt in the future. And that's obviously, we can print the dollars and we have the reserve currency and that keeps it together, and that's why we haven't had a debt crisis like we saw in Europe, but nonetheless, it's unsustainable debt load. And if you then think about the criticism that it's now getting from, in this case, Elon Musk, and some in the Senate too, there's a sentiment building around this debt, this
Rand
budget.
Paul, Ron Johnson,
Exactly.
Yep.
So they're all kind of looking at this like, are we really going to add another 4 or 5 trillion of debt to what we already have? And as that accrues at that with more interest payments, is it really going to help our economy? So there's some doubts about it. The market, however, has said like, well, if you're going to cut back one way or the other, then yields should be going down. Right? That's what happened in the 2011 debt ceiling issue, for example. Will not happen this time that much, but it could at least be some sort of spending reduction built into this final bill that the market will tell you, okay, it probably is not going to maybe that much debt being added to this total bill than what we initially got. So it takes a little bit of pressure off the long end of the yield curve, which has been pricing in this debt load as an unsustainable snowman.
I mean, but it's still going to be a lot, and it's still going to be unsustainable, right? In other words, like, is there it's interesting that you do think that it will be smaller spending and smaller additions to the deficit in the eventual bill, but is there sort of a magic number that it has to come down by in order for yields to come down?
So that's a really difficult question, Julie, because people have tried to calculate it, like what is sort of the debt to GDP ratio, that if you have growth, say at 3%, that things don't change anymore. And then that should actually stabilize not only the debt, but also ultimately interest rates. And years ago, you had Ken Rogoff and Carmen Reinhardt writing about it, like 90% debt to GDP ratio. That's sort of the threshold. Well, we're well above that now, right? So, and yields have actually not really become 10% or 20%. We're still sub 5% because we have the reserve currency. We've got the Federal Reserve with its big balance sheet. We got a lot of money market funds here, a lot of cash that keep buying treasuries. We got banks who do that too. So I'm not sure if there's a magic number, but it is about like we got to do something about these long-term liabilities. That's obviously now creeping really in the mind of lawmakers, that we got to a point where it just got too far, and we cannot continue on this road, or we will face some kind of a debt crisis, however it will play out. So I think the market's sort of sitting here that, yes, if you're not doing anything about it, then we will add more incremental risk premium to these treasuries, and then that's the fraction.
Let me ask you another theme today, Ben. And the market actually advanced earlier in the day on this, is when we learned Trump and Xi had a phone call, and Trump characterized it, says it was a good talk, said something to the effect of, we straightened it out. What exactly they straightened out, the details, we don't know, Ben.
Yeah.
But I am curious, when you try to size up the US and China right here, who do you think the market thinks has the leverage there?
Yeah, it looks a lot like China has the
Why
leverage.
do you say that?
Well, the critical minerals that we really need for auto production, that's where the sticking point was. And it really looked like that we had to reach out to China to get this goal going and get a better understanding to move the talks forward. Now, whether they actually result into an agreement, that's all to be seen. So there was a little bit of relief on that call, at least on that news. But it's China has the upper hand here, and the market's still pricing it like this is going to be more de-escalation. In order to get that issue resolved, it's quite technical. China wants to see lower tariffs and different barriers. And as much as we try and negotiate on China bringing your barriers down so we can start selling finally in China more stuff that we produce, that's still to be seen. So I think the market's sort of sitting here. It's not going to escalate anymore. It's going to potentially be de-escalating. And that's only a positive, I guess. We're just going to continue with this rally ultimately. That's why the drawdowns in the market become so much smaller on days when you had these negative headlines about trade. The market's really implying like, yeah, this is a situation where as much as we surpass maybe even the deadline in July or August, not too much of a risk.
So it sounds like you're pretty bullish, Ben, between that risk receding and if you think yields are going to not, go back up from here, really.
At least not for let's say, the debt dynamic issue.
Got it.
But for the economy itself, it could, because the irony here is that as we do de-escalate with this trade war, and the stock market continues to rise and financial conditions get looser, the economy gets more breathing room, yields should go a little bit higher from here. So you could still see the 10-year test 5%. Not impossible, but not for the debt dynamic. It's really for the relief on the trade war.
Right, and then maybe that wouldn't be a problem for stocks if it's going up for that reason.
Right, the good news idea, that I think is what the market's been in that rhythm for now.
Yeah.
It hasn't paid to this budget bill that way, like, oh gosh, we got bad news on that and therefore the market goes down because, we can't get this together, get all the uncertainty on that. Yeah.
All right. right. Thanks, Ben. Good
Thank
to
you.
see you.
Good
Thanks
to see
for
you.
coming
Thank you,
in.
Ben.
Thank you.
All right, let's get to Lululemon earnings. They're crossing the wire. The share's down a quick 13% here. That looks to be has to do with the company's revenue forecast for the second quarter. So I'll tell you that first. Net revenue for the second quarter seen by the company at $2.54 to $2.56 billion. Analysts on average had estimated $2.57 billion. It also looks like that the company's forecast for the full year for net revenue leaves it room to miss estimates. For the first quarter, earnings per share met estimates, $2.60. And in the first quarter, net revenue at $2.37 billion. Comparable sales, which we always look at for this company as well, they were up 1% in the first quarter. America's comparable sales down 2%. International up by 6%. So seeing a little bit of weakness here in the U.S. and the Americas, which is their biggest market.
And this stock, Julie, it was already down about 12% year to date heading to this print, and now you're down another quick 12 or 13% here, at least initially in the after hours. I do see the CEO, that would be Calvin McDonald, trying to sound an optimistic tone here. McDonald talking about in the first quarter achieving growth across channels and categories and markets, including the U.S. he calls out. He talks about guests responding well to product innovations and newness and brand activations. Does characterize the macro as dynamic, is how he puts it.
I also want to call out, as I look down here, to the increase in net revenue, or I should say the comparable sales, let's go there, for China, which has also been a big market for them. So it looks like the China change was 7%, a 7% increase. If you take out the effect of foreign exchange, you get an 8% gain. So still seeing that sort of relative strength in China relative to the rest of the world. On a net revenue basis, China's revenues were up 21% or 22% in constant currency. So that's something I know that investors have been watching. Let's get more reaction now to Lululemon earnings. For that, we bring in David Swartz, Senior Equity Analyst at Morningstar. David, it's good to see you. What is going on with Lululemon, particularly in the Americas? Is this a competition issue? Is this a merchandise mix issue? Why do you think we are not seeing better performance in their comps in the Americas?
I think it's both of those things. We have seen over the last few quarters that competition has had some impact on Lululemon, which is unusual because Lululemon historically has always been able to overcome competition. It's really nothing new in this industry. Lululemon has always faced imitators and contenders, but we have seen some companies like Alo Yoga and Vuori, to name two, that have done very well in the upscale women's athleisure space, and that has affected Lululemon to some degree. We also have seen a situation which Lululemon has kind of struggled to get the right products into its stores. The company had a change last year in its design team. Their lead designer, Sun Cho, left to become president of Vans, and that did affect Lululemon, I think, for some time, and there has been a reorganization of that part of the business. I still think that Lululemon is very strong in product development, but we haven't seen it quite as much recently. And then also, it's just a natural slowing down of Lululemon's business in North America. The company already has stores in all major metropolitan regions in the US and Canada, and so it was almost certainty that it would not be able to post the same kind of growth rates that it had in the past. And so that's why it's looking for places like China and Europe for a lot of future growth.
David, what is this company's tariff exposure, and how are they navigating that dynamic?
Yeah, so like just about everybody else in this industry, Lululemon uses a primarily Asia-based production, primarily third-party factories. I don't think Lululemon has a lot of direct exposure from China because, like others in this industry, including Nike, a lot of the production in China has shifted to other countries in recent years. And also, a lot of the production in China is actually designed for Chinese consumers. And Lululemon has been opening a lot of stores in China. But Lululemon certainly has exposure to countries like Vietnam and other countries in Southeast Asia, which have emerged as major sportswear producers in recent years. and it does have high exposure to the U.S. So it certainly does have exposure to tariffs, but Lululemon does have pricing power. Its products are generally more expensive than others, and so I think it can actually raise prices to offset tariffs better than most of their competitors.
And what about its business in China? I mentioned before that we saw comps there rise at a faster pace, but that's been the case there than in the Americas. Is that business meeting your expectations, and is that momentum going to continue, do you think?
I think maybe it has slowed down a little bit because there were times when we were seeing growth rates over 30% in China. Lululemon is opening a lot of stores there. It's still a relatively small business. If you look at competitors like Adidas and Nike, they have thousands of stores in China. So Lululemon could conceivably open many more. It's a market, though, right now that is troubled. We've seen some pretty weak results from sportswear companies in China recently and apparel companies overall because China's economy has not been very strong. And that's especially true with high youth unemployment in China. And that's affecting companies like Lululemon. And so, we may see a bit of a slowdown there, but it's still a very high potential market for Lululemon. Its market share right now is still very low and awareness is low. And it certainly could be much higher in future years.
David, correct me if I'm wrong, but I believe you have the equivalent of a hold on this name. So what would you need to see, David, before you were telling clients to get more bullish?
Yeah, so before today's report, my fair value estimate was $315. So I thought it was maybe a little bit overvalued. Now with the stock down in the aftermarket today, maybe it's a little bit undervalued. I would like to see the company get its growth rate in the Americas back up a little bit. We're never going to see the same kind of double-digit numbers that we saw in the past, most likely. But if it could get back into like the single, mid-single-digit range, that would certainly impress investors, and I think that could potentially get the price a little bit higher. But Lululemon stock price tends to be very volatile. At times, it often gets to be quite expensive. Certainly, when it was over $500 a share, I was maybe one of the few people who thought it was really expensive and overpriced. But there are buying opportunities. If it continues to go down, this could be a buying opportunity in Lululemon, I think, because this is still a very strong company with incredible earnings power and cash flow and no debt. So there's a lot of things to like with this company.
David, always great to see you. Appreciate that instant analysis. Thank you.
Thanks.
Well, Broadcom earnings there just crossed the wire. We're going to get you those results on the other side. Stick around. Much more market domination overtime that's coming up. Taking a look at Broadcom shares, the company's second quarter results just hitting the wire here. Q2 adjusted EPS comes in at 158. The street was at 156. Revenues, $15 billion. Consensus was $14.96 billion. And turning to the guide, Julie, they're calling for, it looks like Q3 revenue of about $15.8 billion. Analysts have been looking for $15.72 billion. At least initially here, the stock's at about 2%.
Yeah, I mean, keep in mind where we have been for this stock, right? It closed at a record high yesterday, and it really has been, in many investors' minds, the other chip AI play besides NVIDIA. Broadcom increasingly making chips, custom AI chips for other companies as well. So that's been a big part of their business, and it's expected to grow more. Hock Tan, the CEO, saying in the statement, we expect growth in AI semiconductor revenue to accelerate to $5.1 billion in the third quarter, delivering 10 consecutive quarters of growth as our hyperscale partners continue to invest. So this is something that investors are still going to look to them for, but perhaps right now you're not seeing like huge jaw-dropping increases, perhaps that wouldn't justify the gains that we've seen.
Yeah, they're calling for Q3 AI semiconductor revenue here, right. $5.1 billion. Street was at $4.79 billion. Also, this stock, I mean, keep heading into this print, it was up about 15% this year. It was up around nearly 90% over the past 12 months. So expectations high into this one. For more of a closer look, Broadcom's second quarter, let's get to research senior equity analyst. That would be Angelo Zeno. Angelo, good to see you. So results are out. Saw a bit of a dip here, at least initially in the after hours. We're down about 2%, Angelo. But give us your reaction to the print.
Yeah, I mean, I think you guys laid out the numbers really well, Josh. And, overall, the numbers were essentially in line for the April quarter and even the July quarter top bottom line. I think adjusted EBITDA was slightly above where we expected, but nonetheless, I mean, for the most part was in line. And this was really a name that was running really hot into the print. And we had seen a ton of good news over the last 2 months. So a lot of that positive news flow was really kind of baked into the stock here. I will say this, you guys alluded to the AI semi numbers, I think 4.4 billion for the April quarter, and that was essentially in line where expectations were. And to your point, the July quarter guide, that 5.1 billion, I think is a really impressive number. It's a notable step up in terms of revenue. And when you kind of just look at like 5-6 quarters ago, this was a business, the AI semi revenue was at a run rate sub $10 billion. It's now, based on the July quarter guide, you're talking north of a $20 billion run rate. So Hock had alluded to the fact that, the served addressable market was north of 60 to 90 billion here 2 years out. So we think there's still a lot of upside to be had on the AI story for Broadcom.
Yeah, and it looks like it's going to account for nearly a third of that third quarter revenue. How should we think about the rest of the business, Angela? We talk so much now with Broadcom about AI. We kind of forget, and with every company that has anything to do with AI, we tend to not talk as much about the stuff that, the other 2/3 of the business. So talk to me about that and how investors should be thinking about that part.
Yeah, so I mean, this, I guess, quarter, their AI semi revenue as far as total semi sales inflected and is now half their revenue, right? So that's a good thing. So now the AI portion will increasingly become a bigger part of that business and help, continue to drive, we think, high teens growth for this company here over the next 2 to 3 years at the very least. When you kind of think about their other businesses, the strong guide for AI semis essentially means their non-semi outlook is probably below where expectations were if you kind of look at the fact that they essentially guided their revenue number in line. So you're kind of looking at some of these more cyclical oriented businesses, their wireless business clearly more tied to Apple. And then you kind of look at their carrier infrastructure business, among other kind of their other segments. Looks like it's just running below where expectations were. But the belief was it was going to be more of a late second half 2025 story. So hopefully we start seeing some momentum on that side of things later this year. But clearly, I mean, the valuation of this stock has nothing to do with the non-AI piece of the business, right? It is all about that AI momentum. And then when you look at the software business, what they've done with VMware is just absolutely incredible. It is, a huge part of the business when you look at software, over 40% of their revenue. Growing north of 20% on a year-over-year basis, and now this is actual, it's all organic growth when you look at it. So very impressive with what they're doing on the software side of things and their ability to really expand the margins there.
Angelo, for investors listening right now who want exposure to that mega AI trend and theme, as an analyst who covers this space, these companies so closely, Angelo, would you consider Broadcom a core holding in that theme?
We would. We do have a buy recommendation on the stock. It is one of our favorite AI semi plays out there. I will tell you this, our most recently published target price was $235. It clearly blew through that. We'll revisit that target price here overnight. But I will say this, I mean, when you look at the addressable market opportunity and then you look at this company, and more importantly today, it's not necessarily the numbers here, it's what they have to say on this call. It's what they have to say about potential new customer wins. It is what drove the stock the last 2 quarters after they reported. We'll see what they have to say in terms of new customer momentum, recent customer wins, when that potentially starts ramping. Could it be sooner than expected? All that is going to be really important to hear on the call and potentially drive upside here to the shares. But yeah, I mean, it is a core name within our AI type of recommendations out there. But I will say this, when you look at it from a valuation perspective today, it is also our most expensive AI semi name.
Angelo Zeno, CFRA Research Senior Equity Analyst. Thank you, sir, as always, for your time.
All right, thanks for having me.
All right, time now for what to watch Friday, June 6th. Starting off, of course, with the labor force. We're going to be getting May's full jobs report in the morning. Economists forecasting job growth to slow compared to April, with 126,000 jobs being added to the U.S. economy. Unemployment holding steady at 4.2%, signaling no major layoffs or job losses in May. And hourly wages ticking up to 0.3% on a month-over-month basis, suggesting that employers are still competing for those workers.
Taking a look at the economy, we'll get some fresh data on the consumer coming out in the afternoon with consumer credit. Economists see a slight dip with that number coming in at $10 billion, hinting that Americans could be slowing down their use of credit cards and loans amid a challenging economic landscape for consumers.
And finally, Summer Game Fest kicking off in Los Angeles. Major companies and brands from across the industry will be in attendance, including the big three console makers, Xbox, PlayStation, and Nintendo. This is coming as Nintendo did launch its long-awaited Switch 2 console earlier today.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.